Hey everybody, welcome to the channel if you're new. So as I told you before, I am working on my becoming a or not a life insurance agent, just an insurance agent, probably more like a health agent. So I will be recording this. This is the study guide you take. Let me see if I can get this figured out.
Life is uncertain. Unexpected illness or death can result in serious financial hardship. Through insurance, an individual or group can transfer the financial risk associated with potential loss to an insurance company, insurer. The insurer, in turn, promises to pay a stated amount if a specified loss occurs. Certain concepts are basic to all types of insurance, including risk, loss, and risk management. This lesson covers those topics. Risk management. How we deal with risk is called risk management. Underlying risk management are several important elements that are key to understanding insurance. Risk, loss, exposure, peril, hazard, risk. Risk is at the heart of what insurance is all about. With insurance, risk means the chance of loss. In this sense, there are two types of risk. Pure risk. Speculative risk. Pure risk involves only the possibility of a loss. There is no chance of gain with a pure risk. Only pure risks are insurable. Pure risks include untimely death, serious illness or disability. Speculative risk can result in either loss or gain. Examples of speculative risk include gambling and investing in the stock market. Because they include a chance of gain, speculative risks are not insurable. Key point. Risk means the chance of loss. Loss is an unplanned reduction in economic value. Only pure risk, not speculative risk, is insurable. Loss. A loss is an unplanned reduction in economic value. An insurable loss can be either direct or indirect. A direct loss is the immediate result of an event involving an insured peril. An indirect loss is a loss that results from a direct loss. Loss exposure and exposure units. Loss exposure means being subject to a possible loss. The amount of loss exposure facing an insurer has a direct bearing on the premium it charges for a policy. Loss exposure is measured by the number of exposure units assigned to the insured by the insurer during the underwriting process. The risk, and, thus, the premium, associated with any insurance policy is based on the number of exposure units assigned. Simply put, exposure units are the basis for each applicant's premium. Example. During their working years, coal miners are generally exposed to a greater risk of death, accidents, and serious illness than insurance agents and brokers. Thus, life and health insurers assign more exposure units to coal miners than they do to insurance producers. All other factors being equal, this translates into a higher premium for coal miners than insurance producers. Peril and hazard. To understand insurance risk and loss, one must first understand the related terms peril and hazard. Peril. A peril is the direct cause of a loss in the event that insurance protects against. Every insurance policy defines its covered perils. Life and health insurance covered perils include death, disability, sickness, hazard. A hazard is a condition that increases the chance of loss due to a peril or increases the severity of a loss. For example, cigarette smoking, poor diet, and excessive alcohol consumption are health hazards that increase the likelihood of illness or early death. Hazards related to life and health insurance. Hazards come in many forms. For insurance underwriting purposes, they are grouped into three categories: moral, morale, and physical. Moral hazards. These are character weaknesses, habits, and risky activities that increase the possibility of loss. Underwriters look for clues that suggest the applicant's lifestyle could result in a loss, such as DUI convictions for drinking and driving, excessive alcohol consumption, smoking, and reckless drug use. A conscious willingness to defraud insurers, perhaps by lying on an application or claim form, is considered a moral hazard, as is adverse selection, discussed below, which is the tendency of someone at a high risk of loss to try to buy insurance. Morale hazards. These are a state of mind or attitudes that create an indifference to loss. Disregarding one's health, for example, being overweight or inactive, driving recklessly, and generally being less careful because I have insurance for that demonstrate morale hazards. Physical hazards. These are physical conditions that increase the chance of loss. Working in dangerous conditions, for example, coal mining and heavy construction, and engaging in dangerous activities like rock climbing are examples of physical hazards. Likewise, chronic diseases like diabetes and emphysema are physical hazards that increase the chance of death. As a means of identifying physical hazards, insurers require life and health insurance applicants to answer questions about their work and personal activities, and in many cases undergo medical exams as part of the application process. Risk management techniques. Risk management is the natural process we all go through to contend with the hazards and perils we face daily. Common risk management techniques include: avoid the risk, reduce the risk, retain the risk, that is, just live with it, share the risk with others, transfer the risk to someone else. Risk avoidance. Though it would be impractical to try and avoid all of life's risks, risk avoidance is a reasonable strategy to deal with dangerous hazards. For example, refusing to operate a vehicle after drinking alcoholic beverages is a practical way to avoid the peril of injury or death that may result from driving while under the influence. Risk reduction. If avoiding a risk is impractical, it may be possible to reduce exposure to its related hazards. Exercising regularly, avoiding poor health habits, and eating a balanced diet can reduce the risk of illness and premature death from heart disease, cancer, and diabetes. Risk retention. Risk retention is simply the acceptance of risk and dealing with a loss using personal funds. If the potential financial loss is small, risk retention makes sense. However, if the potential loss is great or the risk is high, risk retention may lead to financial disaster. Going without insurance is an example of risk retention. The use of deductibles in health insurance is a risk retention device. Deductibles shift small losses to the policy owner, leaving the insurance to cover more serious losses. Risk sharing. The earliest forms of insurance were based on risk sharing. People who shared a common risk banded together and chipped in to compensate a member of the group who suffered a covered loss. The custom of risk sharing made sense for small groups facing relatively modest losses, but it is difficult to achieve in larger groups. Risk transfer. Risk transfer, transferring the loss to a third party, is the basis for most insurance today. In exchange for paying a premium, an individual or business can transfer the risk of loss to an insurance company. Should a covered loss occur, the insurer will compensate the insured for the value of the loss up to policy limits. Key point. The risk management technique of risk transfer is the basis for most insurance today. Elements of insurable risk. Before an insurance company agrees to issue an insurance policy to an applicant, the company determines whether the applicant represents an insurable risk. To be insurable, a risk, and the potential loss it represents, must conform to certain standards. The type of loss resulting from the peril must be definable, and must be definite as to time, cause, and location. Loss of life or health is definable and generally definite as to time, cause, and location. The value of a potential loss must be measurable. Insurance policies include a provision clearly stating the amount they will pay in the event of a covered loss. The insured peril must be outside the insured's control. Though death is inevitable, it is an insurable peril because of the uncertainty as to when it will occur. Self-inflicted injuries are not covered under most health policies, and suicide is excluded for the first 2 years of a life insurance policy. The risk must be part of a large group of similar, or homogeneous, risks that the insurance company can use to predict future losses. The potential loss must not be financially catastrophic, for example, war. The risk must not be one of the policy's stated exclusions. Introduction to underwriting. When an insurance company receives an application for coverage, it begins a process known as underwriting. Through the underwriting process, insurance company underwriters determine if the proposed risk should be accepted or rejected. That is, using the application and related information, they determine if the applicant represents an insurable risk. Law of large numbers. Predicting future insurance losses relies heavily on statistics, probabilities, and averages, all of which are wrapped up in the law of large numbers. Based on the idea that predictions become more accurate as the number of measurable exposures increase, the law of large numbers is a mathematical principle of probability that underlies insurance premium rate calculations. Insurance company mathematicians, called actuaries, rely on the law of large numbers to determine the chance of death, mortality, or serious illness, morbidity, for males and females at any given age. They compile such data into mortality tables, used to determine life insurance premiums, and morbidity tables, used to determine health insurance premiums. Adverse selection. An important goal of the underwriting process is to avoid adverse selection by insurance applicants. Adverse selection is the tendency of persons at greater risk of loss to seek out and maintain insurance. An applicant who engages in adverse selection is displaying a moral hazard. For your review. Risk means the chance of loss. Only pure risk is insurable. A loss is an unplanned reduction in economic value. A peril is the cause of a loss, which insurance protects against. A hazard is a condition that increases the chance of a peril occurring or increases the severity of a loss. Risk transfer, transferring the loss to a third party, is the basis for most forms of insurance today. Through the underwriting process, insurance company underwriters determine if the risk proposed for insurance should be accepted or rejected. The law of large numbers is the mathematical principle of probability that insurance is based on. Mortality tables are used in determining life insurance premiums, while morbidity tables are the basis of health insurance premiums. Please pause the audio and watch the video. You can restart the audio playback at any time.
Welcome to the world of insurance. The richly rewarding field that you're preparing to enter can help you achieve your financial dreams while you help people protect theirs. The first step towards becoming a licensed insurance producer is to pass your state insurance license exam. This prelicense.com course can help you do that. To help you fully grasp the important topics covered in this course, most lessons conclude with a video summary like this, focusing on a central topic of the lesson. This lesson lays the foundation for your insurance studies by addressing the essence of what insurance is all about, risk management. Let's begin by understanding that risk, which in the insurance world means the chance of loss, is a fact of life. Risk management is simply the process we all undertake to deal with risk. This lesson explains that there are a variety of ways we can manage the risks we face. One such technique is risk transfer, which is the process of transferring to someone else the economic impact of a loss. Risk transfer is the basic purpose served by insurance. Through risk transfer, a person transfers the risks of loss to an insurance company. The vehicle used to do that is a legal contract called an insurance policy. Knowing how an insurance policy works is a basic requirement of the producer's job. It's also an essential requirement for passing your state licensing exam. This lesson explains that there are generally two types of risk, speculative and pure. Speculative risk, which involves both the chance of gain as well as loss, is not insurable. Only pure risk, the chance of loss only, is insurable. But understand that not all pure risks are insurable. To be insurable, a pure risk must meet several conditions which are explained in the lesson. First, it must be definable. There must be a name that can be associated with it. Death, disability, and so medical expenses. Number two, the risk must be measurable. There must be a way for the insurance company to put a dollar value on the potential loss. Third, the risk must be accidental or outside the insured's control. A self-inflicted injury is not outside the person's control, and therefore it is not a covered risk. Fourth, the risk must be one that is shared by a large group of people. And lastly, the risk must not be catastrophic. If it involves so many people that a major loss would wipe out the insurance company, nobody is served. As you study the insurance products discussed in this course, whether life insurance, health insurance, or both, notice how they reflect these risk conditions.